Hi, this is John Zolidis. We recently attended the VALUEx conference in Klosters, Switzerland, where we presented on DPC-Dash, which is the Domino's master franchisee for China. And I'm going to walk you through what we find exciting about this idea. Essentially, we see a 30% annual compound return over the next 4 years based on our financial forecasts. But one question that I have and that I talked about with the investors at the conference is whether we can aim to get returns of this magnitude without taking on a lot of downside risk. And I'm going to explain to you how I think that's the case. But first, before we get to that, just want to mention that Quovatus Capital is a registered investment advisor in the state of New York. This video is not an advertisement. It's not a solicitation. It's not a recommendation for this stock or any other stock. You should seek financial advice from your financial advisor. And lastly, I want to disclose that accounts managed by Quovatus Capital have a long position in this security. So, what is Domino's Pizza China? It currently has about 1,000 locations. As you know, Domino's is a global brand. It's outperforming its competitors. Balance sheet's good, and it's 7% owned by the parent Domino's US. We previously presented on this company in September 2023. What do we look for? We are trying to find high ROIC compounders that are earlier in their growth curve that can be bought at attractive valuations. And I'll explain to you why I think Domino's Pizza China fits this profile. So first, here is a chart of return on invested capital at the store level for a group of high-performing restaurant and retail companies with which I'm very familiar. And you can see DPC-Dash has solid returns relative to this peer group. If we look at the store level cash margins, it's right in the middle of the group. Although I would argue that the chain is somewhat immature, and I believe that these margins do offer upside over time. We'll get into that in a little bit more detail. But here's where Domino's Pizza China DPC-Dash really stands out. It is growing its units significantly faster than just about anything else out there in the market. In the current year, they plan 300 store openings on a base of 1,000. Furthermore, it is very, very far from saturation. They're very early in their growth potential, and China, as you imagine, is an enormous market. So we believe that this company can grow for a very long period of time, much longer than just the 4 years or 5 years covered by the financial forecasts underlying this idea. And kind of interestingly, however, you're not paying a big valuation for this stock. It only trades at about 11 times EV to EBITDA. And if you look at the restaurant stocks on this table here, you can see that investors in the US are accustomed to paying very high multiples for businesses that can add many units over a period of time. So unlike these other ones that get these huge multiples, you have the unit growth here, but you're not paying up for it. But this brings us to our investment thesis, and I think this is the key component here, is that we think the business is currently under earning and that the margin structure that you see today underrepresents what the business's true profitability will be. So when you take that into account, the expectation for margin expansion, the multiple being quite low, I think is a mispricing of the security. So what's our plan here? How do we expect to win? If we look out for 5 years, we think they're going to go from 1,000 stores to 3,000 stores. And in that scenario, I think it's very difficult to believe that the stock won't be worth more. In addition to that, we also think the margins can expand from roughly 10% today to the mid-teens. Again, if that happens, the stock should be worth much more than it is today. And we also estimate cumulative free cash flow over this period, over the next 5 years, of 600 million. The current enterprise value is just over $1 billion. If we're right about these free cash flow generation, it's virtually impossible to imagine the stock won't be worth more than it is today. Just looking further out, if we use a 12 times EBITDA multiple, which is roughly where it's trading today, and our forecast 5 years into the future, you get a well over $200 per share stock in Hong Kong dollars, which represents nearly a 30% CAGR on a 4-year basis. All right, here's our financial forecasts and a return matrix. And in the return matrix, and this is an exercise that we do to kind of look at upside versus downside in different scenarios. In the downside scenario, I assumed no improvement in EBITDA margins, no incremental free cash flow generation, and no improvement in sales per average store. But I did assume that they could continue to open roughly the same number of stores. I'm using 2,700 instead of 30,000. And if you assume that the EBITDA multiple contracts to 8 times from the current 11 times, you still get a modest return over the next 4 years of about 7%. Now, clearly that would be very disappointing relative to my expectations. But the point I'd like to make here is to show how unit growth can also create a margin of safety, just in virtue of the incremental revenues and cash flow that can be generated from the unit. So in this scenario where we get really almost nothing of my bullish outlook, I still estimate modest gains in the stock. Obviously, you can have a more apocalyptic scenario where things do go much, much worse, but this gives you a sense of the potential benefit of unit growth over time on an upside and downside scenario. So lastly, summary, you've got a business that right now has solid unit level ROIC and cash flows, is growing faster than just about every other company we look at, and is very early in its growth curve. Despite that, the stock trades at a quite inexpensive valuation. From an investment thesis standpoint, we believe that the business is under-earning with significant margin potential for expansion over time. And using our forecasts over the next 5 years, we're estimating a 4-year potential return of nearly 30% on a CAGR basis, using very modest 12 times EV/EBITDA multiple. Lastly, we think downside is limited or at least protected by the unit growth, and that is one of the reasons that we're so excited about this name. Certainly, there are risks here, primarily that the business operates in China, and you're taking, if you're a US-based investor, FX risk. I will mention that there's some complexity in that the stock trades in Hong Kong dollars, but all the underlying operations are in RMB. And also that they use IFRS accounting, which is not that easy for those familiar or grounded in US GAAP to understand. But nevertheless, these risk factors, I think, are acceptable. And that's it. I hope you enjoyed this video. If you'd like to know more about how we invest in the markets, please sign up for our monthly newsletter and leave any comments that you have below. Thank you.